Today I have James from Consolidated Properties in Brisbane joining us. James, thank you and good to be with you.
Thanks very much for having me, Peter.
James, tell us about your Brisbane projects, what you've been working on, and which parts of the residential market you're focusing on as a business at the moment.
Yeah, sure thing. Look, at Consolidated Properties Group, we've been building apartments in southeast Queensland for a very long time now. The projects that we've got going at the moment, the big one really is Monarch Residences, which is a 215 apartment development on the river at Toowong. That's a very high-end development with the average sale price of those apartments at about $2.1 million. That project is going to wrap up around Christmas this year, which is very exciting for our business. We've got a couple of other projects in development at the moment. The next one in terms of apartment towers will be down at Yurongpilly, which is about 7 kilometres south of the Brisbane CBD. That particular project, it'll be a similar sort of scale, 160 to 180 apartments. It also is almost right on the river, so affords really good views for the purchasers there, which again allows us to achieve those sort of very high luxury prices that we need to achieve to be able to build anything in the current construction cost climate. So look, those are our major apartment developments, and beyond that we are doing a land subdivision down in northern New South Wales, which is in the early stages of rezoning. That's for 550 house lots, which right now is really sorely needed in that particular location where there's just a huge scarcity of supply, which unfortunately is becoming a really common theme across Australia.
James, tell us about the luxury market in Brisbane. I know it's an area that you've been focusing on, you've been working on and delivering some projects on. I find it really intriguing that Brisbane's luxury market is developing and evolving. Give us a bit of an insight.
Yeah, sure. Look, I think it is worth reflecting on where we were 10 years ago in the mid-2010s. Really at that stage of the market, apartments were really viewed as investor product. There were a few sort of companies like Mirvac out there trying to develop really high-end apartments, but the bulk of developments really were focused on selling $400,000 to $750,000 apartments to investors who could hopefully achieve a gross yield of over 5% at that point in the market. So because of who we were selling to, most of the people who we were selling to back then were never intending to actually live in the apartment themselves. It really was a financial investment. And that really did dictate the design of the apartments. The prime thing was they were just a lot smaller, and then also the apartment mix. So typically you would have had around 30% one-bedroom apartments, 60% two-bedroom apartments, and maybe 10% threes back then. And the sort of sizes were, those two bedrooms, they'd be 70 to 80 square metres internally. A three-bedroom would be around maybe 110 square metres internally. So they were generally product that someone who was going to live there for 10, 20 years wouldn't get that excited about. Fast forward 10 years to where we are now, and it's completely reversed where, due to the high cost of construction that the industry is facing overall, we just cannot build investor-type product that can deliver anything more than about a 3% gross yield. And as you can imagine, sophisticated investors are not particularly excited about buying into something that earns them 3% when the cash rate's at 4.1, and a bond yield is sort of heading up towards 5 for the longer duration yield. So we've had to really redefine sort of who we're building for and the product that we're building. And it really has migrated specifically to owner-occupier downsizers, which is not a bad thing at all, because we've got houses all over Brisbane that are filled with couples in their 60s and 70s. And we're talking about 4 or 5 bedroom houses, which is not a really efficient use of real estate when we do have a supply shortage that we're experiencing at the moment. So the key is, though, you've got to provide a product that these downsizers are going to fall in love with. And the two primary drivers really are firstly some kind of aspect or view. So certainly Gold Coast, anywhere on the coast, has had a great run over the last few years. Anything beachfront, downsizers are flocking to. And then for the Brisbane market specifically, it's really been riverfront that's been the big driver for downsizers. So that's the first one. And then the second one really is revolves broadly around size. And so when I said we used to build 70 to 80 square metre two-bedroom apartments now are really 95 square metres plus. And three-bedroom apartments have gone from trying to squeeze it into 110 square metres to really starting at 140 square metres and ranging up to 200 square metres. And really in those three-bedroom apartments, it's not good enough anymore for downsizers just to have one living room. You really need to have two living rooms. They want the flexibility of space so that, if the husband wants to watch the Broncos, he can get shunted off to the second living room, while the wife is out, with her friends in the formal lounge room. So that's sort of part of the design change. I think the size sort of flows through everything. Big kitchens, sort of everyone wants a minimum 3 metre long kitchen bench these days, which necessarily really expands that kitchen space. Master bedrooms, that they really need to be sort of approaching 4 metres by 4 metres to get people excited. And then walk-in robes is another one, which used to be sort of for famous people, I suppose. Big walk-in robes, and now everyone wants this big cavernous space where everything can fit comfortably. Those are some of the design changes internally, and then probably the other big one that I sort of haven't mentioned is just the balconies. In the Queensland climate, it really is an outdoor living scenario, and you really need to be making sure you've got, firstly, appropriate depth of at least a 3 metre deep balcony, and then you really need to be approaching sort of minimum 4.5 to 5 metres wide so that people can actually have a good sort of 8-person table and a lounge setting out on their balconies.
One of the trends we talk about often, James, is the downsizer market, and downsizers moving from their big homes and moving into apartments with amenity. Now, in terms of the downsizers that are moving into the projects that you're working on, are they local downsizers? Are they interstate downsizers? What type of downsizers are we talking about going into that luxury product?
Well, look, I can speak directly to the experience that we've had at Monarch Residences. So out of those 215 apartments, we've now sold 210. So there's 5 remaining at the moment as we speak. We've sold about 80% of those apartments to owner-occupiers in the end. Out of that group, it's about 87% have come from within 5 kilometres of the development, which, to be fair, it was what we were expecting initially when we launched our sort of design and marketing. But I guess, when you look at it in those sort of figures, it is quite confronting just how big that local population of buyers, or how important that local population of buyers is for a project to be successful. Look, we certainly have we've attracted a couple of buyers from Melbourne, a couple of buyers from Sydney, not a lot of offshore buyers for the project, largely due to the pretty onerous FIRB regulations and the high cost of stamp duty and those sort of things now. And then also regional Queensland has actually been interesting, where people are moving down from areas like Gladstone or Bundaberg to spend their retirement in Brisbane. I think generally the challenge with selling off the plan in Brisbane to the southern states is really one around timing. If it is someone who has made a life choice that they want to leave Melbourne and come to Queensland, typically they haven't sort of made that choice quickly. It's been a long time in the making. Now they've made it, they actually want to get here. And if you've got a project that's still 2.5 years from completion, it's not really a perfect fit for those sort of buyers. I think Gold Coast probably is slightly different, where a lot of those southern state buyers of Gold Coast are seeing it more as a holiday house where they might come for 1 or 2 months a year. And so for them, they're happy to buy and sort of wait the 2.5 years. But that's probably the biggest limiting factor, I think, to attracting southern investment or southern buyers into some of our off-the-plan product.
I think the Olympics are on everyone's lips when they're thinking about Brisbane. And from a property development perspective and a residential property development perspective and delivering on projects, how are you viewing the Olympics? Are they actually complementary? Are they a challenge for you? Are they an opportunity? What's it like on your end?
Look, I think there's two aspects to the Olympics that are playing into our industry. The first one's really more of a negative, to be honest, which is just the pipeline of works that actually need to be done and how they're actually going to get completed with the sort of ever-depleting construction workforce that we have up here in Queensland. And I can come back to that in a minute. But the second one is really just what the Olympics really is all about, which is sort of global recognition of your city. And we actually saw that literally, going back 4 years when it was originally announced. Within a day of the Olympics being announced, we had random Japanese investors calling our office line saying that they wanted to invest in Brisbane real estate now that it was going to be a global city. So that was quite amazing to see that sort of immediate reaction. Obviously, that recognition builds and builds as we get closer, and I think the Brisbane Lord Mayor was over in Paris doing some sort of interesting studies during the last Olympics, where they'd previously sort of gone out on the streets in London, I think it was, and asked people whether they knew whether they could point to Brisbane on a map, and I think it was about 4 or 5 out of 100 could point to where Brisbane was. And then they did the same in Paris, and at the Olympics, obviously front of mind, that increased to about 22 or 23 people out of 100. The expectation is by the time you're at LA, it'll be sort of half the people can actually point to where Brisbane is on the map, and then after the Olympics, hopefully most people in the world can actually point to it. So I think that recognition of Brisbane as a great market to be in is really important for just the macro tailwinds of our industry, which really comes down to population growth and foreign investment. So I think there will be benefits there, but we're not really seeing it just yet.
I remember in 2016, 2017, all the talk was around Brisbane's apartment oversupply. And we're now at a point where Brisbane is actually struggling to build apartments, or there's challenges, construction challenges and costs on delivery. Give us a bit of an insight as to how challenging construction is, where the challenges are, and what's happening to construction costs.
Yeah, look, it's actually really remarkable to reflect on it and think back to 2018 and 2019. We could not sell an off-the-plan apartment. And it was because literally every week in the Australian or the Courier Mail, there was a headline of this supply glut of apartments in Brisbane. And it absolutely terrified, it spooked the investors. Anyone thinking about purchasing would get reminded on a weekly basis that it was a terrible idea. And it's just quite comical almost that 5 years on from that period of time and we're in a complete undersupply. Look, I think the drivers of the undersupply that we're facing are reasonably well known. Brisbane and southeast Queensland generally has been the recipient of a lot of interstate migration, at really record levels, and that has meant that I think it's something like 150,000 new people entered southeast Queensland in the 12 months to I think it was June or September last year, which is a lot of people looking for a home. And then when you sort of on the supply side, you have a look at the challenges of building, and those challenges have been varied. It sort of started obviously with supply chain disruption through COVID, but then it's really moved on to just a chronic shortage of supply of labour. And look, Master Builders Australia reckon at the moment that effectively for every 2 people who retire from the construction workforce, there's only one coming in. So effectively, year on year, 2 go out, 1 come in, and you can see how that shrinks your workforce very quickly. I think the stats on apprenticeships and things like that are really quite confronting. Where 10 years ago, the completion rate of apprentices was around 71%. Now it's actually down to about 52%. So even if you can actually attract apprentices to enter the industry, only half of them are actually seeing it through to become qualified tradies. So look, that's the situation that our builders and subcontractors are facing, and it's been a huge headache for them. You think about a plasterer subcontractor who's been asked to sign up to a fixed price contract for a 2-year construction build on a multi-storey apartment building. And, their part of that build might kick in from, month 12 to month 15, for example. So they've got to somehow forecast how they're going to have access to labour, to actually deliver a job that they've signed up to do, in 12 or 15 months. It's just incredibly difficult. And what it's led to, initially, it was just impossible to forecast, and that's why we saw so many of our subcontractors just being unable to fulfil the fixed price contracts that they'd entered into, which either resulted in liquidation, which is a terrible outcome, or the subbies having to ask the head contractor for a top-up on the contract to be able to deliver it, which a number of head contractors have done that just to be able to sort of keep their projects moving. But ultimately, what it means now is, they've all been burnt, and through no real fault of their own. Like, this is an industry dislocation that literally no one really saw coming, and now, so when they're pricing new jobs, they certainly don't want to get burnt again. So they're really having to be ultra cautious in the prices that they quote. So if you've got a project that's 18 months out, they may be factoring in a margin of 20 or 25% now to make sure that, if it does cost them 10% more to get the labour, at least they've still got a 10% margin left in the job for them.
Now, we've seen a sentiment shift ever since the RBA cut rates a few weeks ago. We've seen it in our business. I'm seeing it across the industry. The market's starting to heat up. What's your view on the RBA's announcement? And how is it impacting your pipeline and your planning and your projects?
Yeah, look, I think the interest rate cut certainly welcome from a cost of living approach, I suppose. And there's lots of Australians who were really, really hanging out for that cut, and our construction workforce sort of fits into that bucket as well. I think in terms of sales in Brisbane have continued to be really strong. And it's just this chronic undersupply, and it's coming through in the numbers where, CoreLogic, every month it sort of feels like Brisbane prices go up another %. We haven't quite seen that in Melbourne, where, that's probably been flat for the last 12 months or so. But it's been hot up here, and really what that comes down to is just, it still comes down to pure affordability of Brisbane versus some of the other major cities. There's actually there's been a lot of press over the last 12 months about how the median house price of Brisbane has overtaken Melbourne, which is a nice headline and kind of interesting, but it's really completely untrue in that, Melbourne is a significantly bigger city where the additional supply that's getting added in that city is 30 or 40 kilometres out from the city centre compared to 20 or 25 kilometres out for Brisbane. And so it's sort of natural, I suppose, that marginal supply being added to Melbourne is probably a lower cost supply than potentially some of the Brisbane supply. But if you just took the inner 10-kilometre ring of Brisbane versus the inner 10-kilometre ring of Melbourne, I haven't done the analysis, but I'd suspect that Melbourne's probably still 30 to 40% more expensive, which, for all those people living in a $3-4 million house in 10 kilometres from Melbourne, you can still buy a lot for $3 or $4 million in Brisbane, which I think just is keeping a natural floor under the Brisbane prices. So I think the RBA probably needed to do something. They've been sitting for quite a long time now, and obviously, the previous governor Philip Lowe got in a lot of trouble for sort of waiting too long to start actually increasing rates in the face of inflation, and that ran away from us, which led to the significant rates rise that we all saw. I think it's sort of sensible to make a cut now. I don't think anyone in the market is thinking like all of a sudden you're going to be able to borrow for half as much so I can go and buy that $2 million house instead of the $1 million house. So yeah, look, I don't think it's going to have a massive effect if I sum that up.
Now, James, last question, my favorite question. You're a really experienced guy. You've got a great track record working across different industries. What have you learnt about yourself as a leader, and particularly about yourself as a leader working in this particular residential development market?
I'll start with the leader one. I think in my career I've worked, so Consolidated Properties where I work at the moment, we're a reasonably small, nimble business. We've got about 20 employees. I've worked in my career at Macquarie, BHP and NAB, and working in those businesses, I think you need to be a very different leader to the sort of leader that you can be in a small organisation. Those big businesses necessarily require a lot of structure because you're generally leading a team of 10, 20 people who then need to interact with another team of 10 or 20 people, and so that process and structure is really important. Hence why you get those big businesses where your entire week is filled up with team meetings as you figure out what everyone's actually doing. The nice thing about our business, like in the residential team which I run, there's only 5 of us, and we all sit within a 3-metre radius of each other, and we actually all come to work 5 days a week. There's no work from home in our business, and so really at all times for us, sort of we all know exactly what each other are doing. And so it allows you as a leader to spend a lot less time sort of managing people and focusing on sort of what they need to be doing. And it actually gives you a lot more time to be on the tools yourself, which for me, I actually really love that. I find it refreshing, and probably the reason why I love it is just how much you learn when you're actually doing. Like, you can definitely learn a lot managing people, but I do still think you learn way more by actually doing the job. And I think it's that continual learning that keeps you interested in your career as you go through. In terms of the sort of investment, investment performance or anything? Yeah. Look, I've sort of had a really mixed track record of personal investments over the years, from private markets to public markets. You learn something from every investment that you make. I think from a professional perspective, with the investing that we do in terms of selecting sites and buying sites, we've got access to an enormous amount of capital in our business, and it's not just the capital of our founder, but it's there is so much capital in the market looking to get involved in development projects at the moment. We have non-bank credit people, banks, investment funds coming to us all the time. So you really could really fall into the trap in this sort of situation where there's lots of capital to really go out and start sort of growing for growth's sake. We really do try to sort of look through the cycle that we're in and be really disciplined with the acquisitions that we make. And just the constant question that we ask ourselves, I suppose, is, if the market changed tomorrow, is this an asset that you'd still be happy to own in 5 years? And so that's kind of the medium-term lens that we look at things through.
Well, James, thanks so much. Great insights. We wish you and the Consolidated Properties team all the best. I want to come and see that view that you have. It looks like a beautiful view. I'm sure it looks even better in real life. And we wish you all the best, and we look forward to catching up with you and having you on the show later during the year.
Yeah, no worries, Peter. Thanks very much for having me on.